Okay, so like, you know how prices can be kind of unpredictable sometimes, right?
Yeah.
Well, like today, we're gonna like dive into why President Trump's proposed tariffs could make things even more, well, yeah, unpredictable, basically. We've got some really interesting stuff to look at, drawn from this BBC News report. And they've got analysis from the OECD in there. And we've also got the perspective of like this former deputy director at the IMF. So like our mission today is to figure out, what kind of economic shockwaves this could all cause.
Hmm.
Not just for the global economy, the big picture stuff, but like what it could mean for you personally,
Yeah.
especially here in the US and for like our neighbors, Canada and Mexico. Like get ready for some surprising connections as we unpack this.
Yeah, it's a really crucial time to be looking at this stuff,
Yeah.
because these potential shifts in trade policy, they can have like huge real world effects. I mean, what really jumps out at me is like how worried the OECD is.
Hmm.
And they're a pretty big deal internationally, right?
Yeah. Okay. So let's get right into that OECD warning then. So their forecast isn't just a little off. It's predicting a major slowdown in global economic growth this year, like down to 3.1%. And they're specifically saying that President Trump's trade war is the main reason for this. So that's a pretty direct link coming from a major global economic forecaster like that.
It is. And when you look at the specifics for certain countries, like the picture gets even clearer. Take Mexico, for example. They were expecting their economy to grow by 1.2% this year. But now the OECD is predicting a contraction of 1.3%. So for you, that's not just a small dip. It's like a total reversal,
Yeah.
a sudden shift from expected growth to actually shrinking. And it's all tied to these proposed policies. Canada's in a similar boat. Their growth forecast got slashed from 2% down to just 0.7%.
And these predictions are based on something pretty specific, right? Like the assumption is that President Trump will actually go ahead with those 5% tariffs on all goods coming from Mexico and Canada starting in April. So this isn't some abstract economic theory or anything. It's a forecast based on a real policy decision that could happen really soon.
Exactly. And it's not just our neighbors who are going to feel this. The OECD also revised its growth outlook for the U.S. itself, down to 2.2% this year, and then even further to 1.6% in 2026.
Hmm.
This suggests that the negative consequences aren't limited to the countries we trade with the most.
Yeah.
They could affect the whole U.S. economy, too.
So how is Canada dealing with all of this? It seems like Prime Minister Mark Carney, like on his first trip abroad, sent a pretty strong message.
He did. His whole thing about economic collaboration instead of confrontation, especially during his meetings in France, is pretty telling. When he talks about strengthening ties with reliable allies, specifically mentioning France and Europe, it seems like a strategic move to maybe diversify their economic relationships if things get messy closer to home.
Yeah, and he was very clear about it too, calling Canada a reliable, trustworthy, and strong partner who shares values. It's like he's trying to present Canada as a stable and dependable option if the economic environment gets more unstable. So when he talks about collaboration and trade, what does that actually look like compared to a more unilateral approach like imposing tariffs without any agreement?
Well, collaboration in trade usually means negotiating agreements, sticking to the international trade rules,
Yeah.
and working together to resolve disputes. A unilateral approach, like you said, imposing tariffs without talking to your trading partners.
Mm-mm.
Well, that can bypass all those rules and it could lead to retaliation. Other countries doing the same thing. Back to you. Carney's message clearly shows that Canada prefers collaboration.
Okay, so let's shift back to the US. It's not like everyone here is on board with these proposed tariffs.
Hmm.
There's a lot of worry about a possible recession, and the latest retail sales numbers aren't exactly showing a booming economy.
That's true. The 0.2% increase in retail sales last month was lower than expected. It points to a slower pace of economic growth. Retail sales are a key indicator, because it shows how much people are spending. Weaker spending can be a sign that the economy is slowing down. And what's interesting is this data comes out right before the Federal Reserve's next meeting.
So the Fed's in a tough spot, right? They're still watching inflation closely. But now they also have to consider the risk of an economic slowdown. And that slowdown could be made even worse by these trade policies. It makes their job a lot harder.
For sure. The Federal Reserve's main tools for managing the economy involve adjusting interest rates. If they raise rates, it can help with inflation, but it also makes borrowing money more expensive, and it can slow down the economy even more. So they have to balance the risk of rising prices with the risk of triggering a slowdown. And all this uncertainty about the tariffs just makes things even more complicated.
Let's step back for a sec and look at what economists generally think about trade wars. It seems like most of them agree that trade wars are bad for everyone involved. A lose-lose situation.
Yeah, that's the general consensus. The basic idea of international trade is that countries should focus on what they're best at producing. It makes things more efficient, and prices are lower for everyone. Tariffs mess up these efficient flows of goods and services. So in the end, it means higher costs for businesses and consumers in every country involved. It's worth noting that even Donald Trump himself has said that tariffs could be bad for the economy.
But the report mentions that some people within the Trump administration think differently. They think the long-term benefits of these tariffs will eventually be greater than any short-term economic pain. What's their reasoning?
Well, they argue that tariffs can help domestic industries grow, encourage companies to bring manufacturing jobs back to the U.S. And they see tariffs as a way to get better deals in trade negotiations. They believe that these short-term costs are an investment in a stronger American economy in the long run.
And do other economists agree with that idea of long-term benefits outweighing the pain?
Most of them don't. They're skeptical. They worry that the negative effects of trade wars will be really bad and will last for a long time. Things like disruptions to global supply chains, increased costs for businesses that rely on imported goods, and retaliatory tariffs from other countries. They think that any potential benefits from things like deregulation or tax cuts might not be enough to offset the damage from these trade disputes.
And this is all contributing to the volatility we're seeing in the financial markets, right? All this uncertainty about trade policy is making investors nervous.
Absolutely. Financial markets are always trying to predict what's going to happen with the economy. And when there's more uncertainty about trade and economic growth, it naturally leads to more ups and downs in the market. This is where Desmond Lackman's insights are really interesting. He's a senior fellow at the American Enterprise Institute and a former deputy director at the IMF.
Yeah, he thinks that the stock market itself could actually force a change in policy. How does that work?
It's fascinating. He basically thinks that if the stock market goes down enough, it'll put so much pressure on the president that he'll have to change course. He points out that the market has already lost a lot of value recently, around 10% in just 3 weeks. That's about $5 trillion gone poof. And he predicts that if the stock market falls another 10%, President Trump will be under a lot of pressure to back down from these tariffs.
Because a big drop in the stock market affects more than just investors, right? How does it affect the rest of us?
It affects consumer confidence. When people see their investments losing value, they tend to spend less. We're already seeing some signs of that happening. If you add that to a 20% drop in the stock market from its highest point, the chances of a serious economic slowdown get a lot bigger. And that could lead to a drop in the president's approval ratings. So there would be a big political incentive to change policy. Lackman thinks the pain felt on Wall Street could actually lead to a complete reversal on trade policy.
It's interesting how financial markets are tied to political decisions and trade policy. It shows how high the stakes are.
For sure. And it shows that financial markets are watching these trade developments really closely. They see it as an early warning sign for potential economic problems.
Okay, so let's talk about the Federal Reserve again. Even without these potential tariffs, they were already dealing with a tricky economic situation. Now it seems like their job is even harder.
Definitely. The report says that most people don't think the Federal Reserve will change interest rates at their next meeting. But their main problem is still the same. How do they deal with inflation without causing or making worse an economic slowdown? And that slowdown could be made even worse by all the uncertainty about trade policy. It's like they're trying to steer a ship through a storm with no visibility.
All right, so let's recap all of this. We've got the OECD saying there's going to be a slowdown in global growth because of these proposed tariffs, and they think it'll have a big negative impact on Mexico and Canada as well as on the U.S. economy. We heard how Canada wants to work with other countries and is trying to build stronger relationships with its allies. Here in the U.S., we've got weaker retail sales adding to the worries about a potential recession, which puts the Federal Reserve in a tough spot. And maybe the most interesting thing is that a drop in the stock market could actually be what forces a change in these trade policies.
Yeah, it's pretty amazing how all these different things are connected. International economic forecasts, domestic economic indicators, what other countries are doing, and how financial markets are reacting. It all comes back to this issue of trade policy and how it could change the global economy.
So here's something to think about. Given how connected the world's economies are, how could these trade policies, something between the U.S., Mexico, and Canada, have ripple effects in other parts of the world that seem totally unrelated? Think beyond the headlines and consider the long-term consequences for global supply chains, the decisions businesses make about where to invest, and even global political stability. It's a complicated web, and it could take years to see the full impact of these policies.
That's a good point. The global economy is so interconnected, the impact these policies won't just stay in those countries. It's worth thinking about how businesses and consumers and industries that seem far removed from all this might end up feeling the effects.
Thanks for listening to The Deep Dive. We'll see you next time.
See you then.